wanted to do a quick video for our lovely Wealth Club members to celebrate our new branding. You'll notice we look slightly different. Big thanks to Grim Designs for this fantastic refresh. And of course, to celebrate new tax year's eve that's coming up. I'm Farah, a financial coach and founder of Empowering Wealth. If this video is your first intro to us, here's a quick overview of what we do. We are on a mission to make financial literacy and financial well-being accessible for everyone. Whether you're an individual, couple, community, group of kids, whoever you are, run a business, and you just want to get your finances under control and feel more confident about money, we are here to help. We focus on education and guidance in plain English, not advice, and not using that usual finance bro jargon. We want to keep things simple. Today, I'm doing this video to give a quick overview of preparing for the end of the tax year. So the tax year is coming up. I'm going to talk to you about why the tax year matters. What is the tax year? It is a pivotal time to review your personal finances and take advantage of being tax efficient and the products out there to help you be tax efficient. Basically, get ready for the new year. And then I'm going to maybe cover off a few key terms that you might come across. Hopefully no really complex jargon busting, but we'll talk about a few terms that will fly around as the tax year comes to a close. And finally, the main part of this presentation will be to dive into exploring what people usually consider at the end of the tax year. Now, this presentation is covering all sorts of scenarios. So no matter who you are, whether you're just starting out on your financial well-being journey, you're just trying to get control of your finances and figure out what's going on, or whether you're further advanced down the journey and you're thinking about building your wealth and passing it over to next generations, we're going to cover all of it. But I do have to give the usual disclaimer that we at Empowering Wealth, we provide general financial information and education and coaching or financial guidance. So this is educational and information only. It does not constitute regulated financial advice. Everyone's circumstances is different. We're all unique. So as I said, we're going to be pretty generic during this presentation. So if you do need specific recommendations or decisions, please consult a qualified regulated financial advisor or tax professional, or give us a shout. We can talk things through with you and see if there's anything we can help with or signpost you to the right people, the right places. Right, with that said, let's dive straight in and explore, like I said, what people usually cover during the tax year based on their circumstances. Right, first of all, what is the tax year? Why does it matter? Right, in the UK, the tax year runs from the 6th of April of one year to the 5th of April of the next. Why the 6th of April? What's the meaning behind that? Really, there's nothing that extraordinary about it. It's really tradition-based. It goes back centuries, back to the medieval times when we used something called the Julian calendar, and then we shifted to something called the Gregorian calendar. Our new year originally was actually the 25th of March, which was actually called Lady Day, I believe. So anyway, it really has nothing to do with any sort of recent financial regulation or anything. We just landed eventually on the 6th of April centuries ago. It's quirky, but we stuck with it. Other countries usually align their taxes with their calendar year, but we love to be special here in the UK, and we use the 6th of April to the 5th of April. Now, what exactly is this window, this 12-month window for? Well, it's this official window that the government uses to take as a measuring stick for what is your earnings, your savings, your investments, any tax allowances or benefits that you're eligible for. It kind of gives them a 12-month official window to look at your finances and determine how much tax you need to pay. Think of the 5th of April as the New Year's Eve for your finances, I guess. So you may have certain allowances, like an ISA allowance, that you need to use up by that date, or you lose them as we go into the next year. So I like to think of it like just like the end of my normal year, the 31st of December. If I've got a job that gives me holiday allowances, I check to make sure that have I used up all my holidays? Do I have any that are able to roll over into the next year? Or if I have gift vouchers or something that are expiring before the 31st of December, I might want to use those up. So think of the 5th of April as your financial New Year's Eve. And that's when you'll want to finalise certain financial tasks and think about using up any of the allowances that are available to you. Remember that you don't have to use up everything. So, there are some allowances that if you don't use them, you lose them. So following the next tax year, they start again, and you lose the allowance that was in the previous tax year. But honestly, I don't want anyone to stress out about it and kind of think, oh my God, this is a really big sale event. I have to do this now. We're all about stress-free finances. So let me go through some jargon actually first before we jump in to set the scene a little bit. So these are terms that I'm probably going to mention as I take you through what are the different steps to thinking about the end of the tax year. So first of all, income tax. Those of you that don't know, income tax is a tax on most types of earnings, your salary, if you do any freelance work, if you've got any rental income, different tax rate bands for different income levels. You've got the personal allowance. Your personal allowance is related to income tax. So that's the amount of income you can earn tax-free each year. Above that, your income tax bands start kicking in. Then we've got pension contributions. So I've done a separate guide on pensions. I'm not going to go too into detail about how pensions work here, but your contributions are basically the money that you pay into a pension, which is a savings account for your retirement goals. And these contributions can actually lower your taxable income. Now, why would you want to lower your taxable income? Because if you lower your taxable income, it potentially can move you into a lower tax band, so you pay less tax. You can also get tax relief on your pension contributions. Again, something that I cover in the pensions guide. But yeah, I'll be talking about pensions in the next few slides, so wanted to clarify that. Let's quickly cover capital gains tax, because I'm going to be talking about capital gains tax. Capital gains tax is the tax that you may pay on any profits when you sell or dispose of assets. So let's say you've got some shares or funds or maybe a second property. This doesn't apply to your primary residence. This is talking about additional properties. If any of those assets that you have increased in value, you may have made a profit, and that is where your capital gains tax starts kicking in. The capital gains tax allowance, which is the amount of profit you can make without having to pay tax, is now £3,000. This is from April 2024. I don't know when you're going to be listening to this video, so please, whatever figures I do mention throughout this presentation, double check, because numbers change depending on what the government sets in their budget, etc. So definitely check those. And if your gains exceed the capital gains tax allowance, you then have to pay capital gains tax on that surplus. And now finally, ISAs, because we're definitely going to cover ISAs in the next few minutes. And ISA is often referred to as a tax wrapper, which basically means it's an account that protects your savings or investments or shields them from certain taxes. You won't pay income tax, dividend tax, capital gains tax on anything that you make when your money is in an ISA. So on interest, the returns or the investment growth that you achieve while your money is inside your ISA. Think of it like a protective bubble around your money when we talk about tax. Okay, so now that I've covered these main terms, I'm going to go into, again, the 10 actions that we would consider during the end of the tax year, just to make sure that we have a strong finish to the end of the tax year. We kind of want to sail right through it as if it never even happened, really. Not like having a big party, but you can if you're, really passionate about celebrating your finances. That's great, love that. But yeah, main thing is we don't want to stress out while we're doing it. So these are 10 steps. Not all of the 10 steps will be relevant to you. So take what is relevant to you. If anything, this is just really information just to get an idea of what some people consider when they're going into the tax year and preparing for it. We've got just over a week left before the end of the tax year. So again, don't stress out if you've not done any of these steps. At least you'll know about them and we can talk more about them. You can contact us. We can have some more conversations about money and tax years, etc. At least you're going into the new one knowing a little bit more, hopefully. So right, let's go into it. So the first step that I want to talk about, and if you've done any coaching with me or any of the events that we've held, I'm all about getting financial clarity first and foremost. So I'm always thinking about check your situation, check what your allowances are and your personal details. So in particular, when it comes to the end of the tax year, I'm talking about check your tax code. That tax code is basically how HMRC estimates how much tax to deduct from your salary. If you're an employee. If your tax code is wrong, you could be underpaying or overpaying tax. This could be wrong for many reasons. You could have changed jobs, maybe be eligible for different benefits. Marriage status may have changed. So look at your recent pay slip. Does your code match HMRC's letter to you or notice to you? If not, you can contact HMRC to correct it. I've mentioned also the personal allowance. It's that how much you can earn before paying any income. If you are married, there's something called marriage allowance. If you're married or in a civil partnership where one of you has an income below the personal allowance, which is at the moment 12,570. But again, depending on when you're watching this, it could have changed. It is possible for the person who is earning below the personal allowance threshold to transfer a portion of their personal allowance over to their partner. So, and that's only if their partner pays the basic rate tax. I won't go too much into the detail of this, but I just wanted to flag that. So if you think you or your partner might qualify for marriage allowance, do a quick eligibility check on the HMRC website. So actions for number 1, check your tax code. And if you're married, do a quick eligibility check on the marriage allowance. Right, moving to number 2, maximizing ISAs. So this is pretty common for all of us. All of us should be eligible for an ISA allowance. Each year, you can pay up to £20,000 into an ISA or ISAs. Again, I mentioned this shelters your money from income tax, dividends, capital gains tax. You can pay all your money into one ISA, or you can spread it across different types of ISAs. Now, again, this is an end of tax year overview, so it's not an ISA guide. We've got a separate video for that. So if you want to learn more about the different types of ISAs and the nuances and which one might be best suited for you, that's a separate video, separate guide. But I'll just quickly cover cash ISAs. Basically work like a regular savings account, but the interest that you earn is tax-free. Stocks and shares ISAs are where you can invest in funds, shares or bonds. They're higher risk but potentially higher returns over the longer term. Again, they're different from trading or general investing accounts because they are shielded for any gains that you make while your money is invested in a stocks and shares ISA is protected from capital gains tax and dividends tax. We've also got the lifetime ISA. So for those that are younger adults saving for their first home or retirement, you can consider the LISA, the lifetime ISA. The lifetime ISA also has its own eligibility criteria and conditions of how you use it. So I'm not going to cover that here. But if you are between 18 and 40 years old, you can open a LISA and you can make contributions until you're 50 at the moment. Again, check those depending on when you watch this video. So yeah, like I said, you can pay into as many ISAs of each type as you like, with the exception of the LISA. You can only have one LISA. And this one, your ISA allowance is a use it or lose it type of allowance. So there's no rolling over into the next tax year. You have to fill it up by the end of the tax year if you can, or you lose it. Now, £20,000 is the allowance you get. So if you're lucky enough to have that much in savings, then you'd want to consider whether an ISA is the right place for moving those savings. And I also mentioned flexible ISAs. So during the tax year, you might have withdrawn some money from your ISA. Flexible ISAs allow you to replace that money within the same tax year without it counting towards your annual limit. So if you did take funds out earlier in the year, check if your cash ISA is flexible so that you can put any money back in before the 5th of April to still use that allowance. Quick note or nod to the kids. If you have children under 18 or nieces, nephews, grandparents, anyone under 18 that you might also want to contribute to a junior ISA. We'll talk more about family a little bit later on, but just wanted to give a shout out to the junior ISA. So for number 2, maximizing your ISAs. Really, I mean, if you've got some time, revisit your goals and think about what am I trying to do with my finances? What are the right places for my money? And if an ISA is the place where you want to put your money, make sure that you make any deposits that you need to before the 5th of April. So that's really important. One thing that I do get questions asked, especially around this time, about, should I open a cash ISA? Should I open a stocks and shares ISA? Which platform should I use? What should I invest in? Oh my gosh, I've got to do this all within a week. Don't worry. Look, the worst thing to do is make decisions when you're feeling really under pressure and you're not sure about anything, and you don't have enough information available to make the right informed decision. If you are undecided, at least if you know you want your money in an ISA, in a tax shielded wrapper, then at least get that money into the wrapper. Some providers let you hold your money. So some stocks and shares ISA providers let you hold your money as cash and then you can invest it later. So for example, I remember when I had to make a transfer into an ISA, into one of my stocks and shares ISA, but I wasn't ready to decide the investments right then and there. I needed a month to figure out some other stuff. So it was just held in cash. and then I invested it later. So don't worry about that. I mean, obviously, it's not ideal to hold it in cash because you want to be earning returns, or you want to be invested. But again, this is all about making sure it's stress free. Or if in doubt, put the money in a cash ISA, or open a cash ISA if that's appropriate for you. And you can also switch the funds to a stocks and shares ISA later when you've decided exactly which one is right for you. But remember, when you're moving money between ISAs, follow the proper ISA transfer process so that you don't lose the money, or you don't lose the wrapper status. I mean, so you want to make sure that money stays in the bubble, stays in the wrapper. So don't take it out and then try and put it back in. There is all providers and banks have a transfer process that they do for you. So make sure you stick to that. This one is time sensitive. So the contributions that you make do need to clear before midnight on the 5th of April, which I believe is a Saturday, right? So check your bank's processing times. You've got some time to do it. So yeah, I would have a look at that for sure if that's something that you want to do. Right, so we've done know your allowances and details, consider maximizing your ISAs, and number 3, optimizing your pension contributions. And I say this is not things that you need to do. These, again, things that people usually consider when they're thinking about the tax year. So let's go into pension contributions. As I mentioned, the contributions are the money that you pay into your pension. You have an annual pension allowance every year. Most people can pay 100%, like all of their earnings, into a pension, or up to a maximum of 60,000 into their pension, and they get tax relief on their contributions. There are exceptions if you are higher earners, as well as people that have already made taxable withdrawals from their pensions. Those are a little bit different, but generally, you'd have to be really kind of well off, or have a decent amount of savings to make up to that maximum of 60,000 in terms of your pension allowance for the year. There's also the possibility, so this allowance is slightly different from the ISA allowance, in that there is a possibility at the moment, this could change, to carry forward unused pension allowances from the previous 3 tax years if you had a registered UK pension during that time. So you could take what's your allowance this year, what was your allowance last tax year and the tax year before, to really make up those pension contributions. So if you realise that you're really late in the day in saving into a pension, and you want to kind of boost that pension, or put money into it, you can actually put quite a large lump sum in. But again, ensure that it is processed before the tax year to make sure that you use that tax year's allowance. Okay, so we've covered kind of the annual allowance, and that's you can do extra contributions. You can do that through either your personal pension, if you've got a personal pension, or your workplace pension scheme. So if that's the case, if you want to add to your pension and you've got a workplace pension, your employer may have certain deadlines on how quickly or when they need to process your additional contributions before the tax year ends. It usually has stuff to do with payroll processes. So if in doubt, contact your HR function and ask them what those internal deadlines are. Again, this is time sensitive only because providers can take a few days to process contributions. So again, don't leave it until the last minute if that is something that you want to consider, if you think that your pension contributions is something that you want to do this tax year. I put that as number 3. I'm not saying it's kind of what you do after you maximise your ISAs. It's just something that is a little bit more complex to calculate your allowance than an ISA. But potentially it can be more beneficial, as I've said, especially for that tax relief if you are a higher rate taxpayer. And I also want to mention something about the state pension. Again, I don't want to make this whole presentation explaining all ISAs and pensions and all the nuances. I've done a separate blog on using or filling in gaps in your national insurance record to maximise the state pension that you're going to get. So I will provide a link to that, or check out the blog. But yeah, so that's something that you want to consider, especially this year. So there are, I think the deadline is this year for actually filling in some previous years NI gaps. I think it goes back to 2006, but don't quote me on that. But I just wanted to call that out. If you do have any gaps in your national insurance records that date back to 2006, you can actually fill them. So I went through this kind of review about a couple of months ago, actually, because I started working as soon as I was basically legally able to work. And I realised that because I was working and I was studying, I had some gaps in my national insurance record because they looked like part years of employment, because I was sometimes working, sometimes in education. So they were seen as not full years, they were just seen as part years. So they were considered gaps in my national insurance record. So I was able to decide whether I wanted to plug those gaps, and instead of showing, for example, half a year on my national insurance record back in 2006, 2007, it would show a full year, and it would help me get the full state pension. Now, I've written a little bit about this. Again, I don't want to go into too much detail here because we don't have time. But that was a really interesting decision or analysis that I had to do, because I had to really think about, do I want to plug the gap, or do I expect that I will still continue working and I'll make up that gap by just paying my national insurance because I'll be working anyway? And it's not going to make a difference because you need around 35 years of national insurance contribution years. But anyway, I will, if you're interested in looking at that, Martin Lewis has done a really great blog on that as well. He's covered that quite a lot in his shows and in his on his website. So take a look at Money Saving Expert on state pension and filling in national insurance gaps, or have a look at the blog that I've written. That kind of explains it in a summarized version as well. So, right, we've talked about knowing your details, ISAs, pensions. We're going to move on to, so before we move on, these are three things that pretty much everyone can look into doing. I'm not saying everyone should be doing each of these three things. Definitely, I'd say everyone should be doing number one. But number two and number three are things that you'd want to consider doing. So you may not end up taking any action at all, but I want you to be aware of these actions and think about what you want to do for next year so that it's not so last minute. Okay, so now we're going to go into something a little bit more relevant for people that have investments or assets outside of ISAs. So we're going to talk about capital gains tax. Capital gains tax, as I mentioned, is the amount that you may owe on the profit that you make when you sell or dispose of certain assets if they've increased over time since you bought them. Things that would be sitting open to subject to capital gains tax is shares or investments that are sitting in a non-ISA account. Remember that ISA gives it that protection. A capital gains tax is only if you've got anything sitting outside of an ISA. Shares, second properties, buy-to-let properties. For some people, maybe you're an art collector, an antique investor, a jewelry collector, and you're doing that to make profits and basically make a return on your collections. It's important to, I think I mentioned it before, your main home, the one you live in as your principal residence, is not subject to capital gains tax. So if you want to move house and you're selling your house and you're selling it for more than what you bought it for, if it's your primary residence, then don't worry about it. That you're not subject to capital gains tax there. So what I would do if I'm thinking about capital gains tax is, first I would think, do I have any potential capital gains tax liability? What assets actually do I have? So this is where, in our Master Your Money Foundation, of course, we talk about knowing your net worth and knowing what you have. What assets do I have, or do I plan to sell this year? If I do or have sold anything, I'll check the purchase price, what I sold it at, what I bought it at and what I sold it at. What's my total gain for the tax year? And do I have any capital losses? Do I have any losses rather than gains that can be offset against a gain? You might not have anything. So if you don't have anything, don't worry about it. If you do, you might want to consider something called the bed and ISA strategy. So the bed and ISA strategy is a way to use up your capital gains tax allowance and move your investments from outside of an ISA into a more tax efficient wrapper, into an ISA. So I've included a diagram here that you can find on the Interactive Investor website, and they've kind of, I like diagrams, so that's why I kind of picked this one here rather than creating my own. So this is basically showing that if you have, let's say, a stock you bought, I don't know, you've been given shares in the company that you work for, and they're sitting in a trading account, so not in an ISA. You can actually move the shares from your trading account into a stocks and shares ISA through a bed and ISA process. And that means the shares that you have or the stock that you have is moved across in one simple transaction. You're only charged for repurchasing the shares kind of on the other side once they're in the ISA. The sale of the shares is free. There's no transaction fees there. That's called a bed and ISA, and you can do that so long as you have a stocks and shares ISA and the trading account on the same platform. If you don't, you may have to go the other route, which is that grey arrow, which is where you have to sell the stock. You get charged commission on that, or sales transaction fees if they're if that's what your platform is charging. You would take the cash out from that sale, and then you would buy the asset back when it's in an ISA or within an ISA wrapper. Before you start doing it yourself, definitely contact us or speak to a professional. So I would, like I said, figure out, do I have any potential capital gains tax liability? Maybe I have nothing at all. If I do I want to use it and then start moving some investments into an ISA? And maybe I don't have any more space in my ISA. Maybe I've used up my full allowance and therefore I cannot transfer anything into an ISA, at least this year. Then I would think about, well, do I still want to sell my investments and use up my capital gains tax allowance? So given that we're allowed £3,000 of tax-free capital gains, you may want to think about, do you want to sell it and then rebuy investments again 30 days later, just to use up that allowance? But again, it's a little bit complicated. So for those of you that are thinking about capital gains, you may want to speak to a professional, an advisor, or again, have a chat with us and we can signpost you to speak to the right people. And so before I move on from number 4, the rest I'm going to whiz through. But this one is a little bit nuanced, only because, again, I get kind of questions from people. Before they come to me, they've got so excited that, they were like, oh, you know what, I've started investing. And we talk more about, okay, what have you invested in? And, how did you go about picking your first investment, etc. And it turns out that quite a few people invest in accounts outside of an ISA. So when they start their investing, they're not aware that they could invest through a stocks and shares ISA, and they just open a trading account on, let's say, eToro or Trading 212 or Free Trade or whatever, and it's not an ISA, and they don't realize that the gains that they're making in their portfolio is subject to capital gains tax. So I did want to mention this because it's not just for people that are, advanced or super wealthy that have capital gains tax. These mistakes are common. And, I wouldn't even call it a mistake. I'll just call it a learning, because anything that we do with our finances, always we're learning, right? So, just wanted to mention that. Actions on capital gains tax before the deadline is basically go through that thought process. Are there any assets that you think might be subject to capital gains? Do you want to do any? How do you want to treat those? And make sure you document everything. I think with the one thing with investing outside of an ISA, you just want to make sure that you keep careful records of when you purchase things, their prices. And if you're doing things through a proper platform, they should give you a tax document anyway, and they should give you good reporting so that you can know how much you've made anyway. And like I said, if you have large gains or a complex portfolio or very specific, a specific situation, you can speak to a financial advisor, an accountant, to help you optimize how to dispose your assets and make the best use of your allowances. But let's see if I can whiz through the rest. Right, number 5, log charitable donations. You can use gift aid and claim additional tax relief. So really think, if you are a high rate taxpayer and you do charitable donations on a regular basis, you may want to think about how to manage that strategy to to really benefit from a tax perspective as well. Number 6, check your family allowances. So we touched on this briefly when I mentioned the junior ISA, when I talked about maximising your ISA allowance. I already mentioned marriage allowance as well, which relates to income tax. So sometimes transferring assets to your partner can actually help reduce the overall tax you need to pay. Not making any, I'm not guaranteeing any of this. I'm just saying you could. There are things that you might want to investigate there. Children's savings. So I mentioned the junior ISA. The amount that you can put into a junior ISA is £9,000. You can also make child trust fund top-ups if they still apply. So the child trust fund scheme closed in 2011. So only if you have a child trust fund scheme set up, you can top up. JSIP. So a JSIP is a junior self-invested personal pension. So a SIP, self-invested personal pension, is a personal pension that we can all have, and there are junior ones as well. So again, it's really thinking some forward planning here. If you've got some kids and you really want to help them out and secure their future, but remember, put the oxygen mask on yourself first. If you've got your own oxygen mask on, then these are other things to consider for your kids and helping them out for their future as well financially. Right, and number 7, work-related expenses. Not everyone will have these, but they still can be valuable ways to save tax if you do. For example, employee expenses, uniforms, equipment, subscriptions, self-employed deductions. You'd want to be tracking your business costs carefully. So make sure you just gather your receipts, keep your receipts for anything that you spend for work, and speak with an accountant if you are in any doubt. Okay, now coming up to the last 3, we're nearly there. Double check the dividend allowance. So if you have large share portfolios, if you're a business owner, director of a business, and you rely on dividends for income, this might be relevant for you. So yeah, check if you're exceeding the dividend allowance and plan that carefully. HNW and complex cases. HNW, for those of you that may not know that acronym, stands for a high net worth individual. And this is someone with liquid assets. And remember, we talk about liquid assets being easily converted into cash. That's what liquid means. Liquid assets, so excluding your primary residence, of at least £1 million or dollars, depending on where you are. So if you are lucky enough to be a high net worth individual, or if you have more complex cases, you may want to get some specific advice before the end of the tax year. Inheritance tax and gifting is also associated with the tax year. You can usually get annual exemptions, set up trusts. Again, as I mentioned, the tax year is there to measure what you're doing within a 12-month time to then determine how much tax you pay. So if you are thinking about inheritance tax planning, again, the end of the tax year is relevant for you to know what are your options for this current tax year. Are there any opportunities for you to gift some of your estate? There's definitely different exemptions and allowances there for inheritance tax planning. EIS and VCTs. So EIS, Enterprise Investment Schemes. There's also Seed Investment Schemes, SEIS, and Venture Capital Trusts. These are higher risk investments. So not everyone, or maybe only a few of you, will really be looking at these. They're eligible for significant tax relief, although they are high risk. So they can be something for advanced investors to potentially look at if they've already thought about if they've already maxed out their ISA, they've contributed to their pension. You could also look at these other tax efficient investments. But again, you've got to kind of measure up why are you looking at those investments? What are your goals? Always go back to your goals. What are you trying to do? And then decide what product is right for you. But again, investment in those products, SEIS and VCTs, are usually earlier than the 5th of April, so definitely check that if you are interested in investing in those. And business owners, again, look at your business structures, think about dividends, salaries, share structures. They can be quite intricate, so they would need to be looked at according to the specific tax year. So again, if you are in any of these situations, like you're thinking about inheritance tax, you're a high net worth individual, you have some complexity there, business owner, etc., book an appointment so you can actually talk through this, talk through the end of the tax year with someone and get some advice. And then 10, really, this one doesn't have a deadline per se, but I'd just suggest getting organised. File your documents, have like a centralised document folder with your receipts, statements, confirmations, all of that in one place. So you just feel tidy. It's like a spring clean, and you can go into the next tax year just feeling good, feeling less stressed, and plan ahead. Refresh your goals, think about your goals again. Do the Master Your Money refresh course, look over those videos and content, and plan your contributions. So we do talk about that during the course, thinking about regular contributions and definitely avoiding any last minute rushing and making rash decisions. So number 10 is really an ongoing strategy, no deadline, but vital for smooth finances. Seek professional help if you are unsure. That's for any of this. Make sure that you're not doing something if you're not sure about it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We've done it. So yeah, I hope that was a very quick overview. I hope that this has been helpful. I hope that you feel less stressed and maybe just more informed about what the end of the tax year means. So again, if you have time to take some of these actions, great. If not, at least you're a little bit more informed, and hopefully this can help for the new tax year that we're about to go into. If you're unsure about any points, let us know. Get in touch. hello@empowering-wealth.co. This is all educational, general guidance. We always aim to give you accurate, up-to-date information, but no one's perfect. So for specific recommendations, consult a qualified professional. But yeah, good luck for the end of the tax year. Wishing everyone a great new year ahead in mastering their money. And give us a shout if you need anything, if you've got any questions. We are here to help. Take care. Bye. Do you? What it is to you?